Reporting for control, that will be chapter 11 on the managerial accounting. Every time when you see control, what's the feeling that you have? So every time when I see control, it's like a not nice feeling. But let's remind ourselves, why do we need the control? Why do we need to do all these things that we're doing? Why do we need the budget? Why do we need control? Why do we need the variances? Why do we need to do all this time-consuming, sometimes unpleasant things? For what for? What's the main purpose here? The main purpose you have to remember is you to be able to achieve your goal. That's why we're doing all the things that you say. That's why we're doing the planning. That's why we set up a mission and vision. We didn't set up mission and vision today, and we're going to talk a little about the mission and vision, but that's why we set up the budget. That's why we set up once you set up your goal, then you start doing the planning, you identify the alternatives, then choosing the best alternative, then you prepare the budget. Which steps you have to take in order to achieve what you want to achieve. Also, you have to allocate the resources that you're getting and how you're spending those resources in order you to achieve, again, your goal. Then we have to do those variance analysis, which is going to show us how efficient we are on the controlling the cost, which cost the cost to achieve our goal. It's everything is in this managerial accounting. It's about you to achieve your goal. Nothing more, nothing less. Even though that sounds scary sometimes with control, with other terms, but at the end is all about you to be able to achieve your goal. Make sense? So today, what we're gonna talk about is about the organizational structure. Once you get your organizations, once you set up and running, now you have to think about the structure of the organization. What will be the winning structure of your organization? So one option you have is to be decentralized system. Your organization to be decentralized. The other option is to be centralized. Both have the benefits and both have negative side. If you ask me honestly, which will be the best system? Honestly, I don't know. Now we have examples, both system working perfect in certain situation. And then we have example, both system work terribly in different situations. Which will be the winning strategy? Maybe mix between both. But let's first see what the decentralization organization benefits and how can we use those benefits for your purposes or for our purposes in order to achieve our goals. First, once we're running this decentralized system or organization of the company, we're going to delegate our work to the managers of the lower level. So we're going to give the level of the managers in the lower level ability to make decisions. Once they do, when they have that ability, that's going to free us time. We to concentrate on more specific things like a strategy, like a mission and vision of the company, how to achieve the goals, planning on the budgeting on that side. Also, by giving the low-level management ability to make decisions, that's going to create more job satisfaction for them. Having in mind that the lower-level managers probably can make the better decisions than us, since they have better information and since they're the one who responding directly with the customers. Now, everything that has positive has a negative, that's out of question. So let's see what's the negative on the decentralized system. On the decentralized system, The negative is that lower level management, usually they don't see the big picture. Also, there will be lack of coordination between the members. The same thing that now you might be experiencing in the group. Is it good to have a decentralized system, everybody to get his work and work on his part? Yes, it's good. But then create a problem that members of the group don't communicate between each other because there's no one single person who to, not to control, but more likely to organize that communication, and he to step up and to be able to coordinate communication, coordinate the activity between the group members. So for that reason, two people might be working on the same part of the report, and that creates an inefficiency in the group. The same thing can happen in the organization. The other thing is that the low level of management objectives are not those of the company or organization. Example will be, how many of you actually working? Can you please raise your hands or click on the hand on the chat room? How many of you actually working? And don't lower your hands. I want to see how many people of you actually working. I would expect probably half of the course to be working, right? That's why you're taking this evening class. So far, only 11 people. Anyway, how many of you? Now, you can lower your hands. Now, I want you to raise the hands only and only those of you who every morning, once they wake up, they're going to work with the idea that, and the things that you have in your head, how can I improve the profitability of the company, and how can I contribute more to my owner of the company? How many of you have that thoughts actually? Okay, one person out of 11. That's not bad. So what that means? That means that the goals of the organizations are not your goals. What's the goals of the owner of the company? Well, he has his own objectives. That's why he opened the company. He wants to create value for himself. What's the objective of the lower level of management or the basic or the simple employee? Their objective is they to get what they can, to get their salary and move on. Is the objective of the organization the objective of the lower level of management and the employee? I don't think so. Does it have to be? Well, that depends what you want. For that reason, there might be difficulty to spread innovative ideas in the organization because people naturally, when they focus on what they want and what they need, they don't want to change, and they don't want to accept innovative ideas or changes in their working place. Now, since we have those benefits and disadvantages of the decentralization system, let's move on and see what kind of reports we need as a managers in order to make decisions. Obviously, if we're using the financial statements, which are prepared for the investors and creditors, that's not going to help us for our purposes, isn't it? Because on that statement, if you're a manager of, let's say, coffee shop, you cannot find on the financial reports of the company what's the profitability of latte coffee. You cannot find what's the profitability for every single client. You cannot find the report that tells you the single shot of espresso the contribution margin is that much. So what we have to do, we have to go and create different reports for different purposes. What will be that? That will be if we want to find the cost of the product, we have to prepare the report for that particular product. If you want to find the expenses in particular store and how much is the profitability, we have to prepare the report for that individual store or that sales territory or that service center. Now, those reports gonna be called segment report. Why? Because catching different segment of the company, not the entire company. Those segments of the business can be by customer channel or by geographical regions, or can be some other means of creating that report. There are two types of key. The two key to building those segment income statements in order to find the profitability of the particular division or particular store or particular territory. First, we should use the contribution format. Why? Because it's going to separate variable from the fixed cost. And it's going to enable us to calculate that contribution margin, which we can use for different purposes later. The other thing is to analyze the cost and to separate traceable cost from the common cost in order to prepare our reports. What's the traceable cost? The traceable cost, the one that exists only and only because of the existence of particular segment or particular product or particular store. Once that product, store, or segment disappear, that cost also disappear. Common cost. What's the common cost? Well, the common costs arise because of the overall operation of the company or because of the overall organization. And discontinue one product or discontinue the entire store, it's not gonna change. It's not gonna make that cost to disappear. Now, the perfect example will be, let's say, internet in your house. Imagine you're paying for unlimited internet, let's say $100 per month, unlimited internet. So if your parents come for a visit and they're watching TV all day, how this going to affect the cost? Is it going to change? No, because it's unlimited internet, you're paying $100. So as you can see, the parents, they're not the one who create that cost. And that the internet cannot be traced to the parents. Those are common costs for the household. But if the parents need medical insurance, that will be traceable cost to the parents. Why? Because the parents, when the parents leave, you don't have to pay anymore for that medical insurance. So the medical insurance cost will be traceable cost to the parents. Now, how are we going to allocate the cost? One way to allocate the cost is to use this proportional method or activity-based costing method. That can help us to identify how the cost is shared between the different segments and how we can trace it to every single segment, which using that cost. Here we can use the proportional method again. How are we going to do that? We're going to calculate what's the total occupied space for those three products. Then we're going to see how much is the cost per square feet for that space. We're going to come up with the total cost, which is $40,000 for the 10,000 square feet space. And then we're gonna see how much space each of those products actually occupied. And we're gonna see that the first product occupy 1,000 square feet, second product occupies 4,000 square feet, and the third product occupy 5,000 square feet. Since we know that the 10,000 square feet, that will be our 100%, then we can easily get the fractions for the 1,000 square feet. 1 divided by 10 will be 10%. 4 divided by 10 will be 40%, and 5 divided by 10 will be 50%. So from the total cost, we're going to allocate 10% to the first product, 40% to the second product, and 50% to the third product. And our job is done for allocation. Now, when the traceable cost, can the traceable cost become a common cost? Yes, it can. It's important for us to realize that that traceable cost for one segment may be common cost of another segment. For example, landing fee which has to be paid to land the airplane. Well, that can be directly traced to the airplane, so that will be traceable cost to the airplane. If that airplane doesn't land to that particular airport, it doesn't have to pay that fee. And if we stop landing on that airport, we don't have to pay any more fee. However, the landing fee, so the landing fee is traceable cost to the airplane. But now, if you're running 3 type of seats in the airplane, you have a business class, you have first class, and you have economy class. Can I trace that cost, landing cost, to the business class? For example, if I have the business class, how much business class drag into that cost? Well, obviously, even if I eliminate the business class completely, I still have to land the airplane and I still have to pay the landing fee. So for that case, there will be no reason for me to allocate and trace the landing fee into the business class. Why? Because eliminating the business class is not going to eliminate the landing fee. For that reason, we're going to say the landing fee that we have to pay for the airplane will be common cost for the business class and common cost for the economy class, common cost for the first class, but will be traceable cost to the airplane. Segment margin is a term which we're gonna use as a best guide to assess the profitability on the long run for a segment. So we're gonna try to find what's the segment margin. How are we gonna find this one? First, we're gonna subtract the variable cost, and then we're gonna subtract the traceable fixed cost of a segment from the contribution margin that we already calculated. Let's see this example when we have 2 separate divisions in this company. One division is computer division, the other division is television division. Television division itself contribute to the company division margin of $60,000. That comes from the $30,000 sales. Then we have the variable cost of goods sold, 120,000. Other variable cost, 30, and that's create a contribution margin, 150. After that, we have those traceable fixed costs, which are related only and only to the television division. So if we eliminate the television division, the variable cost is going to disappear. Other variable costs will disappear, and this traceable fixed cost will also disappear. And now we have our division margin, which is $60,000. Now, let's see the entire statement. When we combine television with the computer, we're going to see that the computer also has sales, variable costs, traceable fixed cost, and divisional margin. Divisional margin for computer is 40,000, for television 100,000. Both divisions contribute to the company. Division margin $100,000. After that, we have this common cost, which are common only for the company. That will be accounting salary. That will be the CFO salary. Those will be the one that will be those $25,000. And once we subtract the common traceable common cost for the company, we're gonna get the net operating income. Now, what we're gonna do if we start going further and trying to create a different report, which gonna be more deep report for the television division. As we said before, we might be able to see that some of the traceable cost can become a common cost. Let's see this, and let's split the television division into the two different divisions. In this case, that will be our product line. One product line, we're going to prepare the regular TV. The other product lines will be related to the big screen TVs. Now, the regular TV, let's see, the regular TV is going to contribute to the company $60,000, where the big screen contribute $10,000. Overall product line margin here is $70,000. But as we can see it up in the chart here, our television division itself producing 60,000. So since that report that we're trying to create will be based on this report, so the divisional margin should be exactly equal to what we get in here, 60,000. But if we combine the regular and big screen, we're gonna find 70,000. So that means that they'll be out of the common cost, out of the traceable cost here, which is 90,000, there will be a traceable cost for each of those subdivisions, product lines, and there will be the $10,000 common cost, which is related only and only to the television division. So again, the traceable fixed cost for the television division will be split between the traceable fixed cost for the two product lines and 10,000 common cost for the television division. Segment reporting. Segment reporting, International Financial Reporting Standard 8, dealing with the segment reporting. You have to be careful when you're preparing the segment reporting. And since the contribution margin approach for the segment reporting doesn't comply with generally accepted accounting principle, it's likely that some manager will choose to construct their own segment financial reports, which will be more on the functional level rather than contribution margin. And also, most likely, they're going to use the absorption costing to prepare that report, because as we mentioned last time, absorption costing is allowed by general accepted accounting principles, not the variable costing. Now, which are the problems with assigning the cost? First of the problem is, since we have so many costs, we can easily forget some of the costs. Also, we might make a mistake to assign to segments some cost which is actually common cost for the entire organization. And the last thing is we might inappropriate allocate cost amongst the segments. Which brings us to the value chain of the organization. Now, in order to understand the value chain of the organization, I want you to think of creation of the product. And I want you to think, if we have a product, on which stage of the value chain we can cover the cost. And if you think closely, you can find out that only in the manufacturing stage of the value chain, only that particular part is going to give us the ability to recover the cost for the entire value chain. In research and development, it's just cost. We don't have a product, we don't have anything, we just research and development. Product design, we still don't have a product. We're in the process of designing the product, but we don't have the product. Manufacturing is the only stage of the value chain that we actually can bring some revenue for us. That's the stage where we're producing our revenue making units. After that comes marketing, then is distribution, and the last thing is the customer service. Because believe it or not, doesn't matter how well you're marketing your product, it doesn't matter how much you, through the distribution, you're advertising your product and make sure the clients know about it. There always will be people who's gonna ask you a question, hey, how can I use this product? So that for that reason, you still have to have a customer service. Which will be the most inappropriate methods for allocating the cost among the segments? Many companies do not correctly handle those traceable costs. First, they do not trace the fixed expenses to the segment. And second, they may use inappropriate allocation for allocating those trace costs. The common cost for the traceable cost. Let's see what the problem with the common cost is. The common cost should not be allocated to the product just because someone has to cover the common cost idea. That should not happen for two reasons. First, you may make profitable product looks like losing money. And second, for the responsibility management purposes, if you're allocating common cost, then you're going to hold managers responsible for the cost that they cannot control. Let's see this example here. You have two subdivisions in this establishment that you're in. You have a bar and you have a restaurant. Somebody prepared this segment reporting, which shows the bar separately from the restaurant. As you can see, the bar generate contribution margin $40,000 with traceable fixed cost of $26,000. And that creates a segment margin of $14,000. A restaurant, on the other hand, contributes $450,000 contribution margin to the company. He has his own traceable cost, and the segment margin from the restaurant is $230,000. After that, we have a common cost, $200,000, and after that, we have profit of $44,000. Now, question for you. If I decide to eliminate the bar and bar only, get rid of the bar. Let's see if I can get rid of it. I decide to get rid of the bar. What's going to happen with my profit? Is it going to improve?
I think it's going to decline.
How much is my profit with the bar? 44,000. If I eliminate the bar, what's going to happen? The $14,000 disappear. So now I can run only the restaurant. All the report is based on the restaurant. But the common cost, 200, they're not affected from the bar. Even I have it, either I don't. The $200 are not affected. So that's why the $200 are common cost. So if I decide to eliminate the bar, I'm going to lose that segment margin that the bar producing. And because the $200,000 are common cost, we shouldn't be allocating those one to any of the two subdivisions that we have in our establishment. So let's see the first question here. There was a series of questions. The first question is, how much of the common fixed cost, 200, can be avoided if we eliminate the bar? And your answer will be?
None of it.
None of it. Why? Because it's a common cost. Now, let's have this. Let's suppose that the square feet is used as a basis for allocating common cost of $200,000. Somebody decide, let's allocate those $200,000. It's sitting there, it bothers me, we have to allocate. And he allocated based on the occupancy. He wants to allocate those $200,000 based on the occupancy. He measured that the bar takes 100,000 square feet and the restaurant takes 900,000 square feet. If we know that occupancy for both subdivisions, how much we're going to allocate from the $200,000 based on the occupancy to the bar, and how much we're going to allocate to the restaurant?
20,000?
How did you get the 20,000?
By adding the 1,000 square feet plus the 9,000 square feet.
Okay,
the
that's going to
restaurant?
give you 10,000 square feet, which is 100%. So 1 divided by 10, it's going to be 10%. Make sense?
So can you say that one more time, Ivan? I kind of lost you where you said 1,000 divided by something is 10%.
How much is the total space that both subdivisions use?
200,000?
No. 200,000 is the cost. How much is the space that both subdivision using?
10,000.
10,000. So out of 10,000, how many square feet the bar occupies?
1,000. So that
1,000.
would make it like 1 out of 10, basically. And then you multiply it by the 200,000 and you get 20,000.
20,000.
Okay.
Make sense?
Yeah.
If you have to allocate the cost to the restaurant, how much you gonna allocate? Again, based on the occupancy. Yes, 180,000. What took you so long? Yeah, that will be one way, 200 minus 20, or 200, 2 times 9%, 90%. 200,000 times 90%. It's gonna give you the same number. Okay, so we're gonna allocate only 20,000, 1 out of 10. of the 200,000 costs will be allocated to the bar. Now, let's say this company decide to allocate common cost. They cannot stop it, they cannot help it. They decide to allocate those common costs. Why? Because just have to allocate it. They feel they have to allocate. Okay, what will be reported now? Once we run the report, we're gonna see that bar is actually losing money, correct? So suddenly appears that the bar losing money. Why? Because we allocated the common cost based on the occupancy of 1,000 square feet out of 10,000 to the bar. Now the question is, if we eliminate the bar, how much of those 20,000 common costs can be eliminated? What will be your answer? Can you people hear me? None of it. Right, none of it. Yes, I can see the responses. Why? Because it's a common cost. So for that reason, shall I eliminate the bar?
No.
No, because if I eliminate the bar, what's going to happen? I'm going to lose money. How much I'm going to exactly lose? I'm going to lose the contribution margin, divisional margin of the bar, or segment margin. In this case, $14,000 will be gone, and my profit from 44,000 is going to drop down to $30,000. So don't eliminate the bar. Stay with the bar. With the bar, you're more profitable. Now, for the control purposes, we're going to split. We're going to try to find responsibility centers in the organization so we can evaluate and keep the people responsible for their actions. So we're going to come up generally there are 4 responsibility centers. Here we're going to talk about 3 of them. First one is the sales center, which is not mentioned here. Sales center is the first responsibility center where the managers are evaluated only and only on sales. Then we're going to have this cost center where in the cost center the managers are evaluated and assessed based only and only on cost. Then we're coming to the profit center. Profits, as you know, is coming from sales minus expenses. So most likely the manager of that profit center will be valued on both sales and expenses. And the last one is the investment center. Investment center is the segment where the manager has control over everything. He has control over sales, he has control over expenses, he has control over the money. He collects all the money, and after that, he can make a decision about investing, how the money is going to be invested. How this looks like? Usually the head office is the one who's dealing with the investing. Somewhere in the middle, you're going to have those profit centers. And at the very bottom, you're going to have those cost centers. Cost centers will be production, something related to production, something related to the cost associated for delivering, marketing, and anything like that. That will be the very low level. A little bit higher level will be profit center, and the highest level will be investment center. So that brings us to the point how we're going to evaluate the performance of those people who are in the investment center. For their evaluation, we're going to use that return on investment. And the return on investment, it's very simple thing. Let me show you something. Let me get something here going. Trying to get something and post it here first. Of course, I'm gonna delete it later, so don't worry. I just need some space. Doesn't give me option here. Anyway, now imagine that you have $1,000, $1,000, which you invested in GIC. You know what the GIC is, correct?
I don't. Could you specify?
Yes. Guarantee investment certificates, that's investment, which brings you a steady profit without losing the principal. Just give you the income, nothing more, nothing less.
Thank you.
No problem. That's the basic explanation of the. I'm trying to find how to. Second, I'm trying to copy this and paste it here, but doesn't. Anyway, imagine you have $1,000. You're investing in those GIC, guarantee investment certificates, which give you some return. At the end of the period, at the end of the year, you check your bank account and you found in your bank account that you have $1,100. Now the question is, how much is your return on investment?
Would it be 10%?
That would be 10%. But how did you calculate it?
100 divided by 1,000?
100 will be what?
Because like we have 100, which is the
Extra.
operating income,
Right, income,
and 1,000 as the average operating assets.
1,000. And you'll be correct. You'll be absolutely correct. So how we calculating the return on investment? By simply dividing operating income to the average operating assets. So since in the beginning of the year, our assets are $1,000 and at the end of the year, 1,000, 1 plus 1,000 plus 1,000 is going to give you 2,000. Divided by 2 to get the average, that will be 1,000. That will be our average operating assets. And since we can see that we're generating 100% out of 1,000, that's going to give us return on investment of 10%. So again, for the return on investment, we're going to use this income before interest and taxes. And for the average operating assets, we're going to get everything, the cash, the accounts receivable, inventory, plant and equipment, and any other productive assets. Which brings us now to interesting point, an interesting discussion that people who doing the finance is doing is they saying and start arguing which number we should use for our assets, because we have so many different type of assets, which one of them we're using the fair market value, for the other we're using something else. Shall we use the historical cost, or shall we use the net book value? Having in mind that net book value is the original cost less accumulated amortization and depreciation up to that point. So people come up that let's use the net book value. What we're going to do, we're going to get the original cost, the acquisition cost. We're going to deduct the accumulated depreciation up to this point, and we're going to come up with the net book value of the long-term assets. That combined with the short-term assets is going to give you the number of average allocating asset, operating assets, sorry. So now, once we have this formula, once we have the formula with Here I can copy and paste. So let's use this one. That's not what I want to use. Sorry. Wrong choice. Let's see if I can put this one. No. So imagine I having this formula. Let me insert a new slides. I'm gonna duplicate the slides and I'm gonna get rid of one of those. And that should solve my problem. And at the same time, I'm gonna get rid of this. So imagine that we have the formula of return on investment, which is equal to operating income divided by average operating assets. Correct? That's our formula from the previous slides, not from these slides. It's right from these slides. Operating income divided by average operating assets. Now, imagine at the end I add time 1. If I do that, am I changing the formula?
I don't think so.
No, we're not changing the formula. But can I say that this 1 is equal to sales divided by sales?
Oh, yes.
Absolutely. And then I can substitute in the formula and I can say return on investment is going to be equal to operating income divided by average operating assets time sales divided by sales. But if I do that, now I can do a little bit manipulation here and it can come out that the return on investment is equal to operating income divided by sales time sales divided by average operating assets. Once I do that, then I'm going to come up with the new terminology. I'm going to say that margin is operating income divided by sales. Turnover is sales divided by average operating assets. So return on investment, instead of operating income divided by average operating assets, once we do the trick with sales divided by sales, we're going to come up with the new formula that the return on investment is equal to the margin time turnover. Make sense?
Yeah, because the cells basically cancel each other out.
Right. Once we eliminate the sales, we're still having operating income divided by average operating assets. But once we put the sales, now we have two new things. We have the margin, which is the how much of our operating income is how much of the how much operating income is coming from the sales, and the other thing is from the operating asset that we have, average operating assets that we have, how much sales we are able to generate. And again, one is the margin, the other one is the turnover. So now we have to find a way to increase our return on investment. What will be our way to increase the return on investment? First, we can increase the sales. Second is to reduce the operating expenses. And the last one is to reduce the operating assets. Let's see how can we do this. Before we do that, we have to understand how the whole formula works. Again, we have our margin and our turnover. So margin times the turnover is going to give us a return on investment. But margin have operating income divided by sales. Sales are sales. Operating income is interesting because operating income is equal to sales minus the operating expenses. So if our operating increase, if the sales increase, operating income is going to increase. Makes sense? If the numerator increase, this number naturally margin is going to increase. If margin increase, return on investment is going to increase. So one way to increase the sales, the other way to decrease the operating expense. Keep the sales the same. Now the question is, how can I decrease the operating expense? Well, once we see what's the in operating expense. In operating expense, we're going to find the cost of goods sold, selling administrative expenses. So any of those, if they are reduced, that's going to reduce our operating expense. That's going to increase our operating income, which is going to increase our margin, which is going to increase our return on investment. On the other side of the formula, we have a turnover. Well, what's the turnover then? How we calculate? We have sales divided by average operating assets. So here what we can play with the average operating assets. If we reduce the denominator, the result's going to go up. Turnover is going to go up. If the turnover goes up, return on investment is going to go up. So how can I reduce the average operating assets? By knowing what's in there. And we can find their current assets or operating assets, and you can find the non-current assets or capital assets. So any of those, reduction of any of those assets is going to give us a reduction of average operating assets. And once we reduce the denominator, our result's going to go up. Turnover is going to go up. If the turnover goes up, that's directly is going to affect the return on investment. So let's see now the example. First, this company has operating income of $30,000. Average operating asset $200,000. Sales $500,000 and operating expenses $570,000. So as you can see, 500 minus 470, that's exactly $30,000 net operating income that the company has. Average operating assets at $200,000. Let's use the long formula rather than the short formula. Let's use margin times the turnover is equal to return on investment. And let's see how we're going to calculate this. We're going to get operating income, which operating income is $30,000 here. Sales are sales, that's $500,000. Then we're going to have here sales $500,000 on the top. And on the bottom, our denominator will be $200,000. Once we do this calculation, we're going to come up with the return on investment equal to 15%. Next period, just decide to, you know what, I'm going to increase the sales. So he increased the sales to $600,000. Well, we have to understand, once you increase the sale, my cost operating expenses also going to increase. But my operating income itself increases as well. Our assets stays the same. We're using the same assets. So what's going to happen now? Our return on investment, my margin is going to go up from 6% here, it's going to climb to 7%. Why? Because our operating income increase. Since the sales increase, but the asset stays the same, that's increasing the turnover from 2.5 to 3, which gives us return on investment instead of 15, return on investment 21%. So with only this increasing the sales, we're able to achieve 6% increase in our return on investment. So let's see another scenario. Here the manager was able to reduce operating expenses by 100,000 and $100,000. So sorry, $10,000. So with $10,000 only, nothing more, nothing less. That doesn't affect our sales, but if we reduce the cost that's in sales at the same, that's going to increase our income. So the operating income from $30,000 moved to $400,000. Everything stays the same. Sales are 500,000. Average operating assets are 500,000. So the increased income is going to change our margin. So the margin is going to go to 8%. The turnover, there will be no changes in the turnover. The turnover is still 2.5, the one that we have before. Sorry, this one, 2.5. So because we increase the operating income by reducing the expenses and everything stays the same, we're able to achieve 20% return on investment, which is 5% increase from 15 to 20%, just reducing the cost with $10,000. Let's see another example here. The manager now decides to reduce the inventory by $20,000. Everything else stays the same. He just reduced the inventory. So in that case, our margin is not going to change because we're not changing operating income and sales. Margin is going to stay the same, 6%. But we change the average operating assets. How? We're reducing them from 200,000. Now the new assets are 180,000. Because of that, our turnover increases. That gives us increase in our return on investment 1.7% compared to the 15% at our original assumptions. And there's one more, I believe. Now that's a little bit more complex, but let's see what's happening here. Manager invests $30,000. So the average operating assets increase. That increase in the sale with $35,000. But operating expenses also increase with 15. So the net increase in operating income is 20%, $20,000. Assets increase with $30,000. So let's see what's going to happen now. Since we increase the sales and we increase the operating income, we expect to see change in the margin, which we see with 3.35% compared to not that 7 compared to 6% in the beginning. Now our turnover, however, goes down. Why? Because first we increase the sales with 35 and then we increase the assets with 30,000. Because of that, both increase the assets, that decreasing our turnover from 2.5 to 2.33. But regardless of that, we're generating a return on investment over 21%, 21.8. So that will be the best scenario for us, all the scenario that we have. Now, which are critiques against return on investment? First one is without the balance scorecard, the management may not know how to increase the return on investment. The other thing is that managers often have cost which they just inherit by the previous managers, which means they cannot control it. So for that reason, it will be hard to achieve return on investment, higher return on investment. And the other thing is the manager which are evaluated on return on investment may reject unprofitable opportunities. For that reason, we're going to use another example or another means of assessment that measure the performance, and that's called residual income. Residual income is the actual operating income less the minimum required return on the operating assets. So how this gonna work? We're gonna check our operating income. Then we're gonna subtract average operating assets time minimum required rate of return that we want from our assets. Make sense? So we're gonna check our assets. We're gonna see how much we want from our assets. And then we're gonna apply our required rate of return. And we're gonna see how much we want. Then we're gonna see how much is our actual income and the difference between the actual income and how much we want. It will be our residual income. Okay, let's see how this is gonna work. Now, imagine this. This company has average operating assets of $100,000 and they required earnings of 20%. How much they want? How much is the 20% for this company?
20,000.
20,000. How much they actually get? How much is their actual income? Can you tell me? It's right there on the question. How much they actually earn?
100,000.
No, the 100,000 is the assets.
Sorry, it's 30,000.
30,000. So how much is the residual income? If they want 20,000 and they actually earn 30,000, how much is the residual income?
10,000.
10,000. So the difference between what you actually get versus what you wanted, it will be your residual income or how much more you're generating of what you want. Make sense? That's what the residual income measures. Residual income measures what you want versus what you get. So the calculation again will be, I have the operating asset 100,000, from which I want 20%. So I want 20,000. I require from my assets to generate 20,000. In reality, I get 30,000. How much is my residual income? 10,000. Residual income, what's happened with that residual income? That's going to encourage the managers to make a profitable investment, which using only return on investment might be rejected. Let's see this example. This company, which is division of Rapport Corporation, has operating income of $60,000. They generating that $60,000 out of 300,000 average operating assets. The required rate of return on the company is 15%. Now the question is, what's the return on investment for this company? Who's gonna tell me what will be the return on investment for this division? The 50% is the required return that they want. What will be the return on investment, however?
5%.
20%. 20%. Why? Because they're generating operating income 60,000 and their average operating assets are 300,000. So 60 divided by 300,000, return on investment is 20%. Don't forget, return on investment is operating income divided by average operating assets. Nothing more, nothing less. Okay, we got that one. Let's move on. Now, assuming this, the same scenario, they have operating income 60,000, average operating assets of 300,000. Now, if the manager of this division is evaluated on return on investment, which we said is 20%, if this manager will invest $100,000 in the project, which is going to generate $18,000 operating income. Tell me what you think. Again, if I measure this manager on the return on investment, which we saw that is 20%, is the manager is going to invest $100,000 in the project, which generate $18,000 income.
Yes, right?
I don't know, you're the managers. You tell me, are you going to invest in something that generates, if you're measured on the current return on investment, which is 20%, because you're generating $60,000 out of 300,000 assets. And if that's your benchmark, that's how you measure based on that return on investment, would you invest $100,000 in the project that's going to generate you $18,000 income? No. Why not? Whoever say no, why not? And if you say yes, why yes?
I agree with Gemini because like 18,000 is not 20%.
No, it's not. How much is it?
18,000
18,000.
basically
18,000, how much?
is 18%.
18% return on investment.
So no.
And if you're measured on the 20% return on investment, would you invest in something that generates only 18%?
No.
No. Even if you combine it with the other project, everything, all the assets combined together and all the income combined together, even if you do that, you're still not going to reach the 20% return on investment. So the answer simply is no, you're not going to invest in this project. The manager is not going to invest because he's going to evaluate it based on the return on investment, and his performance will be not very good. Let's put it this way. Why? Because he's wasting money on the project that doesn't generate 20% return. So now let's see the other thing. If the company require a rate of return now is 15%, would the company want the manager to invest $100,000 in the project that generate 18% income. What you gonna say?
Yes, because
How much we want?
we want 15% of 100,000 and we're getting 18,000, which is 18%.
So
that's a
we
good thing.
definitely gonna invest, right?
Yeah, that's right.
Awesome. Okay, you got this one. Let's keep going then. Yes, they're gonna invest because give you 18%. Next one. This company, again, the same company, has operating income of 60,000 and average operating assets $300,000. The required rate of return for the company now is 15%. What's the division residual income? Again, operating income is 60,000. Yes,
45,000. That's the answer to the question. And you get
45,000 is what? What's the 40,000? 45,000.
So 15% equals X divided by 300,000. And to get like the X to the other side, you would have to multiply 300,000 by 15% and you get 45,000.
What's the 45,000? How much you want, correct? How much they want?
Yeah.
How much? How can we calculate then the residual income?
The difference, right?
The
So it would
difference,
be
right? That's
15,000.
correct. What you get versus what you want. And that will be how much?
15,000.
15,000, yes. Was the first one who get it? I think Jin get it. Or Lindsay also get it. Good job, both of you. Okay, 15,000, that's your residual income. So, now if the manager is evaluated based on the residual income, would the manager invest now in the $100,000 project, which give you 18% return? What you gonna say? Yes or no? What do you think? Yes, absolutely. Why? Because it's gonna generate more than 15,000. Make sense? As long as generating more than 15,000, you're gonna invest in that project. If you generate less than 15,000, you're not gonna invest in that project. And since this project generate 18,000, yes, you're gonna invest. Do you understand this logic, people?
So originally we wanted 15% and now we all of a sudden got 18%. So that's why
18%. So are you gonna invest?
yes.
Absolutely, yeah. That's the question, that's the answer. Yes, simple yes. I'm gonna invest because I'm gonna generate another additional $3,000 for the company. Okay, now the residual income has one main disadvantage. You cannot compare and should not be comparing divisions with different sizes. What that means? Let's imagine these two divisions. You have two divisions. One is one division have a retailer and the other one is the wholesale. The retailer generate operating have the operating assets of $100,000. The wholesale have the operating assets 1 million. For both, we have a required rate of return of 20%. So basically, we want 20,000 from the retailer and 200,000 from the wholesaler. In reality, retailer give us $30,000, which transfer to $10,000 residual income, and the wholesale division give us $220,000 actual income, which gives you $20,000 residual income. If you have to invest, where are you going to invest? In the retailer or the wholesaler, and why? What do you think? In retailer, why? If you choose the retailer, tell me why we're gonna go with the retailer.
Because low. Can you hear me?
Sorry?
Can you hear me?
Yeah.
Okay, so because the lower operating assets with a higher residual income.
You're correct, but put it in the other terms. Express yourself correctly, please. Try to find another way to express yourself. I understand what you're saying because I know what you're trying to say. But now put it in the right words. With the terms that we just covered today. Tell me why you're gonna. I understand what you're trying. Again, I understand what you're trying to say, and you're right. But now use the terms that we learned today and express yourself correctly. Yes, because the return on investment. Can you see what Nicolene put there? Because the return on investment on the retailer is actually 30% versus 22% for the wholesale. Even though the residual income is 20,000 for the wholesale with 10,000 more than the retailer generate higher return on investment. Make sense?
Yes.
Great. Okay, so that's one major disadvantage of this. So criticism against the residual income is based on the historical accounting data, which can be easily inflated, lead to the inflated amount of residual income in the period. Also, residual income does not indicate what earnings should be, and calculating require numerous adjustments on general accepting accounting principles, and we know that we're doing a lot of adjustments in the general accepted accounting principles. And return on investment does not incorporate leading non-financial indicators. Which are those non-financial indicators? Those are presented on the balance scorecard. I'm gonna stop for a sec here. Balance scorecard. What do we need? What the company needs balance scorecard. The balance scorecard is the tool that's going to translate strategy into the performance measures, which everybody in the organizations can understand and accept. The balance scorecard has 4 performance measures. One is the financial, second one is the customers, third one is the internal business process, and the last one is learning and growth. So, why do we need the balance scorecard again? In order to measure the performance of our managers. We can use it as a performance management tool, or we can simply translate our mission and vision and strategy into the performance measures, which will be easy for everybody, employee, and everybody related in the company to understand what we're trying to achieve. Once we have our mission and vision and a strategy, then we can identify what are our goals, and particularly what are financial goals. Financial goals will be the measures for our performance of our financial measures. For the customers, we're going to focus on what the customer wants, what kind of service they want, what kind of products they want. How can we get that product? How can we increase the customer satisfaction? Because we have to understand the customers are the one who buying our products. They are the one who bring our sales. If we don't have the customers, we don't have sales. If we don't have sales, there'll be no financial performance measures. The third perspective on the balance scorecard is the internal business process. For the internal business process, we always have to ask ourselves, what can we improve so we can create more value to our customers, which gonna make them more satisfied, which gonna bring more sales, and that's gonna increase our revenue and improve the financial performance of our company. So as you can see, the balance scorecard is very interesting related, where at the end of the day, everything is going to show up on the financial perspective. If we don't improve anything in the internal business process, if we don't do anything for the customers and create value for the customers, they're going to stop buying from us, and that's going to show up on the financial perspective. How we can improve the internal business process? By learning and growth. Once we learn and grow, we will be able to improve to implement what we learn into the internal business process, which will be improving our internal business process through the new technology, to the new way we are producing our products, or a new way we approaching our products. That's going to increase the customer satisfaction. That's going to give us more options for the customers. That's going to make our product more attractive to the customers. Once we achieve that, the customers going to be happy with what they get, and they're going to ask for more. And that's from where the sales going to come. And once the sales increase, we're going to improve the financials. So if you're not happy with the financials, go down to the chain and find out why you are not happy. Who is not happy? From where the money coming? The money coming always from the customers. Why the customers are not happy? You have to find out what's the reason customers are not happy. Once you find the reason customers are not happy, then you can improve the internal business process in order to create value for the customer. And once the customers are happy, then you'll be happy when you see the financial statements of the company. But before you improve anything, you have to go back and learn and grow. So you have two options. Either you're gonna learn and forget, either gonna learn and grow. If you learn and grow, then you're gonna improve the internal process. And you're gonna see the improvement in the financial perspective. So how you should look at the balance scorecard. Again, the balance scorecard relies on financial and non-financial measures. Financial measures, those are like indicators, which only summarize what's happened in the past. The real indicators, what can change in the future, coming from non-financial perspective. Top managers, they're usually checking only the financial, where the lower management, those are the ones who are dealing with the non-financial. How many balance scorecards you should have? Well, the company should have one balance scorecard. Each individual should have one balance scorecard. Every department can have a balance scorecard. You can create for every product balance scorecard. Personal balance scorecard, when you create a personal balance scorecard, that should be used for the performance evaluation of that person. The balance scorecard should always have the measures which are linked together. If you improve one performance, what's going to happen with the other performance? If you change something in learning and growth, what's going to happen in internal process? If I change something in internal process, what's going to happen with the customers? If I change something in the customers, what's going to happen in the financial? You have to, through the balance scorecard, you have to specify action in order to get the desired outcome. Incentive compensations. When you have the incentive compensation for the employee, the best suggestion is you to use the balance scorecard. Through the balance scorecard, you can create value for your company. Now let's see the example. This company, that's a Jaguar example. They have the financial perspective or financial performance measures, which are the profit and contribution per car. They have a customer performance measures, number of the cars sold and customer satisfaction with the options of the cars that they're producing. They have internal business process, which is the number of available options of the cars that provided to the customers and time to install each option. And the learning growth is the employee skills and installations in installing those different options. So what's going to happen? If we increase the employee skills to install those options, then the number of the options available is going to increase. Also, since the employee now are proficient of installing options, the time to install the options will decrease. That's going to help us to improve our customer satisfaction. Why? Because now the customers have more options available and those options comes very quickly. But what will be the result? The result will be, most likely, we're going to increase the number of the cars sold. Once we increase the cars sold, we can see our profit. The other way we can see it, if we educate our employee, make them proficient of installing the options, they're gonna reduce the time, which is gonna improve the internal process. Customer will be satisfied. Reduced time means less cost. Less cost means higher contribution margin per car. High contribution margin per car means more profit for the company. Obviously, if the number of the cars sold increases, profit too gonna increase. And that was our objective today. We to use the balance scorecard and to learn about the balance scorecard in relation with return on investment is residual income in order to evaluate the performance of our managers and our employees. The other way that you can look at the balance scorecard is on the personal level, and that will be very simple. If, for example, for those of you who are working, since you're the product and the customer is your employer, once you check your bank account, which will be your financial measures, once you check your bank account, you have two options. Either you're gonna like what you see, either you're not gonna like what you see. So if you don't like what you see, you have to focus on the customer. Go to the customer and find out what the customer wants. Obviously, that customer is not satisfied. That customer is not happy with the product of your services. So find out what the customer wants, how the customer wants it, and the easiest way is to change the internal business process. How can you change the internal business process? By learning and growth. Learn new skills. Become more efficient. Implement that one in your daily routine. That's going to improve the time and reduce the time that you're performing the task. You'll become more efficient. You can equip yourself with more responsibilities in the company. The customer is going to notice that, and in your next performance review, you're going to have enough ground to ask for a raise in your salary. So that's another way you to interpret the balance scorecard. How many balance scorecards you should have? Many balance scorecards. And that's conclude the chapter for today.